a soft landing, and some people are saying not just a soft landing, but no landing. It's Fantasyland. It's total Fantasyland. The only people that think about a no landing are career politicians, Federal Reserve, career Federal Reserve officials, and economists sitting in ivory towers, people who are not in the real world. Anybody in the real world, even if you're wealthy, if you're in the real world, you know that the economy is deteriorating rapidly. And of course, it's deteriorating more, particularly for the lower 50% in terms of net worth.
Think. Act. And prosper. You are now tuned into the Money Level Show.
All right. Hey, Adrian, it's good to see you again. You know, we were just at the symposium, and now you're back.
Yeah, well, good to see you. Good to see you, Daryl. Yeah.
So a lot of things have been going on. We've had a lot of fear about the BRICS currency, and we've had Jackson Hole meeting, and so you know, it's a lot to talk about.
I was going to say, it's not been that long. It's only been a month since we were together in Boca, but it seems like an eternity, doesn't it?
Yep. Agreed. So I wanted to jump into the Jackson Hole meeting, which for those that don't know, the Federal Reserve meets at Jackson Hole every year. It's a symposium, and pretty much they discuss their policy and how they're going to move going forward. And so I wanted to read just a segment from the Jackson Hole meeting, and just to get your take on what do you think the Fed's goal is here? What are they, potentially planning? And because we know that the markets are trying to, pretty much trying to predict the Fed, and it seems the Fed keeps surprising the markets in some ways or another. So Jerome Powell said, "It is the Fed's job to bring inflation down to our 2% goal, and we will do so. We have tightened policy significantly over the past year. Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate, and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down towards our objective." So what's your take from Jerome Powell's comments there?
Yeah, I think there's a few things we should say about Jackson Hole, first of all. Remember, Jackson Hole is not just a Federal Reserve meeting. There's central banks from around the world to meet in Jackson Hole. That's the first thing. So Powell is talking not just to U.S. investors, U.S. economists, U.S. policymakers. He's also talking, he's talking to his peers in central banks around the world. So that's the first point, and we'll touch on what that means in a second. The other thing to remember about Jackson Hole is that unlike the normal press conferences after each Fed meeting, there are no press questions at Jackson Hole. And the truth is that normally when the Fed meets, they take action, interest rates up a quarter of a percent. The Fed action is, for the last several years, has normally been well telegraphed, and nobody is very surprised by the action. Then you get a Fed statement, which makes a few very, very minor changes to the previous statement, and everybody loves to pick apart every single word that they use, but normally there's no surprise there. The surprises, if anything, come in the answers to the questions, which are by their nature unrehearsed, although some of the questions are obviously planted, but some of the questions are not. And that's where you get the either surprises, or perhaps more importantly, you get a sense of what the emphasis from the Fed is. Because it's been clear for a few months now that the Fed has sort of on the one hand, the Fed definitely wants to bring inflation, core CPI, down to their core PCE, down to their 2% goal. We can talk about that. But that's definitely, they're very clear and adamant that they want to do that. But I think on the other hand, they realize that there's only so far they can go with raising rates without causing, first of all, severe damage to the economy, and secondly, frankly, without hurting the federal government and their interest, servicing of the debt. So he's trying to get two messages across. But yes, we're 2% is it. We're going to keep on going till we get to 2%. But we're data dependent. We're going to look at how the economy responds to what we've done and so on. I think the emphasis in this talk on the 2% goal was partly because several people have come out recently, including Paul Krugman, the New York Times columnist, who somehow unbelievably won a Nobel Prize for economics. I don't quite know how that happened, because I don't think I've ever read anything he wrote that makes sense. But I'm sure there's something somewhere, but I've never read it. But a lot of people, including Krugman, have come out and said, oh, the Fed should abandon the 2% and make it a 3% goal. Some people have even said, well, so long as it's below 5%, we don't really have a problem. And so I think Powell was responding to those comments that have come out from economists recently, including some former Fed spokesmen, former Fed officials, and trying to be very clear on that issue. So I'm sorry, I've rambled a little bit because it's, I think what we've seen, obviously, over the last 15 months, the Fed has gone from 0 lower bound to 5.5. That is the most, as we talked last time, that is the most aggressive rate of interest rate hikes ever. The pace is much more rapid than even Volcker. And so Powell knows full well the monetary policy works with long lags. And we have to always keep bearing that in mind. It works with long lags.
And part of that is a part of the long lags. I recently did a video on the inverted yields, and I saw like in 2006 when the 2-year was paying more than the 10-year. The yield curve was flat, and then you saw like once 2008 hit, it began to steepen. Is that correct? Like the 2-year and 10-year kind of indicates some of that? Hello everyone, sorry for the break in action, but I want to tell you about the link in my description below. This is to the New Orleans Investment Conference. This conference has been around for years and have brought many people out, such as Milton Friedman, Gerald Ford, Alan Greenspan, and Margaret Thatcher. This conference is put on by Brian Lundeen and his team. Brian is the CEO of Gold Newsletter. This year, they're going to have speakers such as Jim Rickards, George Gammon, Peter Schiff, Rick Rule, Danielle DiMartino Booth, Lynn Alden, and many others. Now, I encourage you to click the link in the description below. You can choose to attend the live event, which I will likely be at, as well as the event that is live streamed. You can support the channel by using my link below, so I encourage you to check that out. Now, let's get back to the interview.
Right. Typically, an inverted yield curve, as you say, when the short end, some people look at the 3 months, some look at the 2-year, but when the short end, it pays more than the long end, and some people look at 30 years, some people look at 10-year, but when the short end pays more than the long term, that is a very, very good indicator of economic troubles ahead, a very good indicator. And the soft landing or no landing camp, a lot of people say, oh, the Fed succeeded, there's no landing, it succeeded in raising rates without a recession. They forget, they're too impatient. They forget that monetary policy works with these long lags. And Powell knows that. And so the economic impact of what's already been done has not yet been fully evidenced in the economy. And so Powell is trying to walk this delicate tightrope. And I don't want to give him too much credit. I will certainly say it's a very difficult job he's got at the moment, but I don't want to give him too much credit because, I mean, part of the reason we're in this position is because of his own actions when he was Fed chairman from 217 through to 221. You know, he tried to raise rates when he first came in, and as soon as the stock market said, "Wait a minute, we don't like this," he pivoted, and that was a huge mistake. And then he kept rates ultra low, with the balance sheet increasing all the way through till COVID, and then of course he more than doubled the balance sheet in 3 months. So I'm not excusing him. I'm just saying where we are right now is a very difficult position.
Mm-hmm. Yeah, agreed. So, so we've been experiencing some pain. I mean, we're seeing like, used car prices, start to come down. We're starting to see like some changes within the markets. And we also see like the amount of credit that has ballooned. I think Americans are at $1 trillion in credit, paying very high interest on credit cards. I think the average is around 22% or something from something I watched. And so the Fed is still hiking and still, I mean, in his comments mentioned that, okay, they may have some more hikes in their tool belt. And they haven't even got to the pause yet, or better yet, the pivot after the pause. And so it looks like we're in for a wild ride. I mean, that's kind of my take on it.
No, absolutely. And I'm a historian by training, and if you look at history, the last period that we need to sort of look at is the period of the 70s, when we had high inflation, increasing inflation, and increasing interest rates. What happened when people seem to forget, when Volcker came in, interest rates were already at 12%. Interest rates were already high when Volcker came in, but inflation continued to move up. And what Volcker did very dramatically was take almost double rates. He took rates in a very short period of time from 12% to 20%. Powell has gone from 0, he started at a much lower level, has gone from 0 to 5. But here's the point that's important. Back in 1978, when Volcker came in, rates were at 12, inflation was also at around 11, 12, right? Volcker took them up to 20 to get meaningfully positive interest rates. We have only just, under Powell, we have only just now, in the last couple of months, gone to positive interest rates. Positive meaning the Fed funds rate is above the prevailing rate of inflation, right? There is no way that Powell can take rates to where they are twice as high as inflation. But Powell simply cannot take rates to 10% right now. That would destroy the economy, and it would also do severe damage to the federal government's ability to service the debt. So he cannot do that. But I think he knows that's what's required. So yeah, we're in for a very, very difficult time. And I think Powell, because Powell realizes that he can't take real rates to double the level. He can't take rates to double the level of inflation as Volcker did, because he knows that his mantra now is higher for longer, right? We're going to keep rates higher for longer to have the same tightening effect on the economy. And that only prolongs the damage. With Volcker, because of the quick action he took, you had a very sharp recession, but a very quick recession. By keeping them higher for longer, you are making it almost inevitable that you have a longer recession.
Yeah, it's I don't buy the narrative that that there's a soft landing. I mean, just seeing the pain right now. I mean, with high credit card interest, I mean, mortgage rates. I imagine mortgage rates could hit 8% if they do any additional hikes. And it just looks bad on all fronts for people.
Oh, a soft landing, and some people are saying not just a soft landing, but no landing. It's Fantasyland. It's total Fantasyland. The only people that think about a no landing are career politicians, Federal Reserve officials, and economists sitting in ivory towers, people who are not in the real world. Anybody in the real world, even if you're wealthy, if you're in the real world, you know that the economy is deteriorating rapidly. And of course, it's deteriorating more, particularly for the lower 50% in terms of net worth. But the only people who think that a soft landing is realistic are people who don't live in the real world. And you pointed out the credit card debt. I mean, you only have to listen to the conference calls of all the companies, Capital One, American Express, which services higher income people, and now Macy's last week. They all talk about, Macy's last week talked about they expected an increase in defaults on their credit cards, but it's been more rapid than they expected. You're seeing this across the board.
Yeah, definitely. So with inflation, obviously the risk here is that the Fed, they can only impact demand, but we still have this supply issue with inflation, especially with energy and commodities. So if they were to start cutting again, is it correct to assume that inflation will start going back up because they didn't? They just impacted the demand side. And the supply side, it still seems like it's a long ways out. I mean, governments are just now starting to pass these bills to bring on more nuclear or uranium and some of these other commodities that are necessary. But it seems like the supply still isn't there, and it takes years to get these mines set up and everything. So can the Fed are they even effective in what they're doing? Because they're just decreasing the demand, and that's temporary, right?
Well, it's temporary, but you're correct. It's also affects certain segments more than it does other segments. So I don't expect the Fed to start cutting rates anytime soon. I'm not in that camp. I think they're going to try to hold on as long as they can and get inflation to their 2% goal. Now, what's going to get us to 2% in the short term will be a serious recession, because that, demand collapses in a serious recession. And as you say, that's only part of the equation, of course, but that will bring inflation numbers down sharply for a temporary period. But then, of course, if you have a recession and at the same time you're still getting higher prices on many goods and services, then the Fed's going to have an even more difficult job, because inflation numbers will start to move back up. This is how I see it. I see it that, in fact, I think inflation numbers are going to start moving up before the end of the year. We'll maybe get another month or two when they'll be lower, but you just have to look at, say, oil. Now, we know the price of energy is not in the core PCE, because ordinary people like you and me, we don't eat and we don't use energy. And that's what the Fed looks at. But let's not forget that the price of energy actually affects everything. So when the price of gas goes up from $60 to $75 or $78, whatever it is, in 3 months, the first impact is on the price of gasoline and on the price of energy, which is not in the core PCI, but it also affects the cost of transportation. So that affects the price of almost every good in the store. But that takes a couple of months before that takes a couple of months before the increased price of oil has an impact on the price of goods in the stores. And so, I think we'll see a lower inflation maybe for another month or two, and then we'll start to see it move back up again. And again, the Fed's in a very difficult place because they cannot do what is necessary to kill inflation. I suspect that we're pretty close to the end of interest rate hikes. We may get one more this year. Powell indicated that. I wouldn't be surprised if we got one more this year or even 2 years. But when we get to the end of this year, I think we're done with interest rate hikes. The question then is, what else can the Fed do? The Fed can keep rates higher for longer, which is very damaging for the economy. And as each month goes by, more and more households, more and more businesses are damaged by higher for longer. The business that had a loan, took out a loan 3 years ago, let's say, a small business, took out a loan at 6.5% or 7% a few years ago. They took it out to mature in December of 24, let's say. So they haven't really been affected yet, other than, demand from their customers. But they haven't been affected yet. But when that loan comes due and it's working capital and they have to roll it over, they go from 7% to 12% if they're a small business. It's an even worse case for AAA and AA companies because they're going from a 2% loan to a 6% loan. So, and all these companies, the point I'm trying to make is that all these companies, just like households, their debt comes due at different times. So every month that we keep rates higher, even if we don't increase them, every month that we keep them higher, more people are damaged, more people are affected. So and keeping rates higher for longer is in effect tightening. We don't have to see rates go any higher. That is in effect tightening. So I think the message I'm rambling a bit, but the message I really want to get across is that a recession in the US is all but inevitable. Nothing's ever inevitable, but it's all but inevitable. And it will be a long recession if the Fed keeps rates higher.
Mm-hmm. What's your take on the Fed's balance sheet? They're decreasing their balance sheet. It doesn't look like it's made a lot of progress. Is it up? Is it just going to stay that high forever? Is that pretty much the case?
Well, to be honest, they've made more progress than I honestly thought they would, because when they started last May, they were very, very slow off the bat. If you look at the first, I'm going from memory now, but the first 4 or 5 months of tightening, they had done less than half of what they had themselves said they would do. And then, of course, we had that huge, when the banks in March, when the banks got into trouble, they suddenly ramped the balance sheet up again. But since then, I have to say, they've actually been on target in reducing the balance sheet, more or less 95 billion a month. But, how long are they going to do that for is another question. And again, as you say, the balance sheet, if you look at 2007, before the 2008 great financial crisis, it was $750 billion. And then before COVID, it was a little over 4 trillion. It went all the way up to 9 trillion. So, so that they're on target to bring it down, but are they going to bring it down to 4 trillion or even to $750 billion? No way. That's not going to happen. That's just not going to happen. So yeah, it's higher than it has been for, other than the last 10 years, it's still at a very, very high level.
Would you what's your take on this? It seems like we're in some type of debt spiral. Like, I don't see the Congress or the Treasury balancing the budget anytime soon. I don't see the Fed's balance sheet coming down anytime soon. At some point, they're going to have to either finance government spending, or there's going to be a lot of social unrest in the nation. And so what's your take? Like, is this just like the cycles of history where governments eventually just become insolvent and you lose? Yeah. What's your take on that?
Yeah, no, I agree. You've raised a lot of issues there. I mean, first of all, there is, as you know, and your listeners know, most of the US budget is entitlements, which includes Social Security, Medicare, as well as Medicaid and other forms of payments from government. But that's most of a budget, and that's not discussed every year. That's not fixed every year. When Congress sits around discussing next year's budget, and when the White House presents a budget, or they're only talking about a small part of overall government spending, right? So apart from the entitlements, which can't be touched without changing the law, you've got interest on the debt, which for the last few years has been a relatively small number because of the low interest rates, but now, of course, it's ballooning as the federal government that issued 3-year and 6-month T-bills, and 1-year T-bills a year and 2 years ago at very, very low levels of interest, now has to refinance at 5% interest. So it's a dramatic increase in that. Well, everybody agrees. When I say everybody, I mean everyone in Congress agrees they have to pay that. So that's non-debatable. So the amount is debatable. The amount you're left with is debatable, is defense and other things, like grants to lesbian dance theaters in Upper New York or something. And very few people want to, there's not a great will to cut the defense budget. Democrats want to keep sending more money to Ukraine. Republicans, I'm painting with a broad brush. Republicans generally don't like to cut defense, but they want to give the army and give the military the latest weapons and toys and everything else. And so there's no real desire to cut the defense budget. So you're left with discretionary spending, which is 20% of the total US government spending. So they could eliminate all of that, which they won't, of course, but they could eliminate all of that, and it still wouldn't solve the problem. And as we all know, there is simply no will on any side of a political spectrum. There is simply a spectrum doesn't have two sides. So, but anyway, you know what I'm getting at. There is simply no will to tackle entitlements, and you have to tackle entitlements if you're going to get the budget under control. But there's simply no will to do that. And so, yes, the budget cannot be right now, in the current circumstances, the budget simply cannot be balanced. I would say it cannot even be brought under control. And the end solution to that is the Fed has to create the money, which is inflationary. Now, Powell, as we know, Powell has made it, if you read between the lines, Powell says it's not our job to tell, the government how to spend their money and so on. But it's very, very clear that he thinks the fiscal side, the government side, Congress, the White House, is not doing anywhere near enough. And the Fed feels they have little choice but to accommodate the government spending.